as I noted, not all AT trading lines should be treated the same. In the following, you're going to see the difference between new and old AT ladder lines and what that means for your trading. When looking at Amazing Trader trading lines, it's important to differentiate between new lines and old lines. Take a look at this dollar Swiss chart. We're just going to eliminate this section over here and only focus on this move to the upside, which is considered an up episode. How do we know it's an up episode? You see rising red lines. As long as these lines, which we call ladder lines, build to the upside, you're in an up episode. Once the market runs out of steam and moves to the downside with blue lines dominating, it becomes a down episode. So when you're in an up episode, in this case, the red lines represent ladder lines that you can buy against because the market is looking to buy dips. They're considered new lines because they're part of the current episode. Once that episode changes and runs out of steam and blue lines start building to the downside, these red lines become old lines, lines that the market's going to target on the downside. So they're no longer lines you want to buy against because the market is aiming to see if they can run stops below any of these lines. And it indicates the market is no longer looking to buy dips as it was during the up episode. So it's very important not only to differentiate what the episodes are, whether they're up or down, but to differentiate what the lines are. Because when you're in an up episode, for example, you want to look to buy against any of these red lines. When you're in a down episode, you want to sell against any of the blue lines because the current episode has new lines in it and the prior episode has old lines in it. And you want to be buying or selling against new lines, not against old lines. Let's look at the same currency for the next day. You can see how the market had turned from an up episode to a down episode. The signal was this pattern right here, directional indicator, which gave a sign that the move to the upside has likely been over and move to the downside had begun. You can see the blue lines are now dominating as we go into a down episode. And in that case, you could sell against any of these blue lines. The opposite of what the price action was yesterday, and ride this ladder down until eventually we'll reach a bottom, at which point these blue lines will no longer be new lines, but will become old lines from a prior episode. So keep that in mind, differentiate between new and old lines, and you'll see a big difference in the way you approach trading, because you'll be buying when the market is buying and you'll be selling when the market is selling, and you won't be trading an old episode when a new episode has begun. Old Amazing Trader lines are important for another reason. The older the line, the more significant it becomes. For example, take a look at this dollar Canada daily chart, and you see how this old line held up here and set the stage for the move to the downside. But there's another reason. When you look at multiple time frames and you see old lines that appear on different time frames, they increase in importance even more. The reason is the more people who look at a line, the more traders, the more investors, the more significant it becomes. So if you look, for example, in this daily chart, and we have a line here at 124.31. If you go to the 4-hour chart, you'll see a similar line over here. If you go to a 1-hour chart, you'll see the line over here. You see a 30-minute chart, you'll see the line over here. So whether you're trading a 30-minute chart, 1 hour, 4 hour, daily, you all have 124.31 peg as a key level. So when you're trading, even if you're trading a shorter time frame, you be aware that 124.31 is the key level on top. If it fails there, the market will likely look to reverse. But if the market gets an opportunity to go at it, it's going to run it and see if they can run stops. So when you look across multiple time frames, look at the older lines, and the more time frames you have, the more significant it becomes. But in any case, older lines, the longer the older line, the more significant, because the more traders will be looking at that line as a key level. This is a good illustration how new lines can become old lines and targets for the market. This is a Euro Sterling chart. You can see we had an up episode over here. This was a key level, the base of the move to the upside. We failed at this old line. I told you the older line, the more significant it becomes. We had two more blue lines, and we went from an up episode, failure here, to a down episode. So where'd the market target? It targeted initially this line from this prior episode. So this line was a new line on the way up. Now it becomes an old line once the episode shifted to the downside. And you can see the market ran stops here. We had an older line over here, ran stops again, and then another older line over here, market ran stops here. But the key takeaway is that in the very short term anyway, this is a 15-minute chart, the prior episode and the lines from the prior episode no longer became support when the market shifted from an up to a down episode. They became targets and a place where the market could run stops.